Hello everyone, welcome back. I hope most of you have joined for today's session. If anyone has a question related to any of the previous topics we have already covered, then we can discuss those in the very start of the session. If there is no further question, then sure. And if anyone has any further question, then please do let me know so that we can, before moving on to today's session, we'll be answering the question related to the previous topic. Anyone has any question? And one more thing, I have already shared a WhatsApp group link with with the team, so they are going to share that. They will be sharing the link with you for WhatsApp group, and along with it, I have also shared those exposure drafts which should be examinable within your exam in September 2020 session. So most probably you'll be receiving those handouts within this section after, I believe, after 1.5 hours or so. And along with this, I think these are the two basic things that you guys have asked me, so I have updated those things. Anything else which is related to the previous topics, do let me know. Otherwise, I'm going to start today's topic that is related to the current issues of section B in question number 1, which is most of the time related to the current issues and how current issues would be discussed within your session. Okay, I hope there is no any such question. So let's start with this question. This is a March 2020 September attempt, March 2020 attempt question. So I'll be discussing with the background of this question, then reading out the question, then we're looking into the requirements and marks allocation, and then we'll be looking into the relevant standards. Those should be discussed. And one more thing, yes, I have provided a summary of few of the standards within this sheet as well. It's a standard summary, so you'll be finding out those standard summary within this section. And another thing that was give me a second. I'll be sharing one more thing with you guys. So it would be, yeah, this is. So this is important standard summary, which was important standard summary. So this document I have already shared with you guys. It's an important standard summary, and how you can look into these standards. This is IS 1, IS 8. I have prepared this file in a very short time, so might be if these things are not visible to you, then you can zoom this out. So to make sure that this is visible to you, if you're looking into the next standard, I'm just showing you the next one page. If this is property, plant and equipment, it's pretty much clear. Then you have the other standard, which is IS 19. So you can see it's very small. The font size is very small, it seems, in this document, but you can zoom it out to find out what was exactly mentioned. So this is how you can look into those documents, or you can review those documents, what were the items those should be recorded. These are the double entries recorded, and all of those data is already available within your file. So if there is any problem that you are not able to see those files, you can zoom those things out. So I have updated major sections of the standards within this file, because those file was very detailed file, so it was not possible for me to share all the data within this file. So I have updated most relevant data within this file. So if this is IFRS 16 leases standard is here, you can zoom it out and you can find out what is mentioned in it. So there's certain terms mentioned, what is lease contract, all of these things are there. I believe few of you have asked to look into two main standards, I believe, IFRS 16 or IFRS 15, and along with this IFRS 9. So I'll try my level best. I'll be going to give you a brief. Yes, this is the summary of Excel sheet notes. Exactly. Yes. And one more thing, IFRS 9. I might be at the very end of this session, I might be giving you a overview of IFRS 9 financial instruments, how data should be accounted for, and what are the items that you need to understand within IFRS 9. And if there is any other standard, do you think we need an overview of that standard, then surely I'll be giving you an overview. But this is something you can review this file in this way, what I have already mentioned. So this is something we already have a file, so you can go through. This is the whole discussion provided within this document, so you can go through all of these sheets by zooming those out. So this is 17-pager document, and I have just provided the summary of most important standard that those are something which were, as far as my understanding is concerned, or as per my understanding, these standards would be something I thought the important one. Yes, that could be one important aspect. This is I'm not sure what source of information is provided within the link provided by one of the colleague. It's studentsvirtuallearn.accglobal.com. Let me review this one, and then yes, that's a very useful link. That is a very useful link for individuals to practice few of their English skills with mathematics skills, and with how you can get yourself ready for the exam. Yes, once I went through these topics, but I think a lot, a handsome amount of time have been passed before what I have seen into this. Okay, let's start with the question. I hope there is no further questions. So WhatsApp link was already updated, provided by ACCA Global, I believe. Yes, this is something. WhatsApp group link was provided by ACCA. This, you might be getting this answer from the organizer, right? So this is the WhatsApp group link. That was an answer provided against that question. So you can refer this link to join WhatsApp group. Okay, let's start with the question. I hope there is no further question related to the previous topic areas. So this question is from March 2020 attempt. So the background of this question is Leiria Company is an internationally successful football club. Leiria Company is preparing the financial statements for the year ended 31st October 2005, but is currently facing liquidity problems. The company is facing some liquidity problems, and it's preparing its financial statements. So you need to provide some insight into the accounting standards or application of accounting standard to some of the situations those were faced by the Leiria company. So if one thing is stadium sale, leaseback. Okay, stadium sale and lease back and improvements is one area where the management of Leiria company wants your opinion on it, how they are going to account for the situation provided within the exam. So Leiria company has entered into a contract regarding its stadium, whereby it will lease the stadium on 30th November 2006 and immediately lease it back. The directors of the Leiria company wish to classify the stadium as a non-current asset held for sale in its financial statement for the year ended 31st of October 2005, as they believe the sale to be highly probable at that date. The sale contract requires the disposal of the stadium for its fair value or the market value of 30 million for Lira company to lease it back for over the next 10 years. The present value of the lease payments at the market rates on 30th November 2006 will be 26 million. So this is the present value of future lease payments, which is 26 million. The market value for a stadium of this type has not been changed in several years, and it's unlikely to change in the near future. The stadium is being depreciated by 5% per annum using the reducing balance method. In the year to 31st October 2006, it is anticipated that the 2 million will be spent to improve the crowd barriers in the stadium. There is no legal requirement to improve the crowd barriers. Lira company has incorrectly treated this amount as a reduction of the assets carrying amount at 31st of October 2005, and the corresponding debit entry have been made to the profit and loss account. At 31st of October 2005, the carrying amount of the stadium after depreciating and deducting the crowd barrier improvement is 18 million. So this is the whole information provided about the stadium to which the company or the Laria company is actually looking to sell it out and leasing it back for a number of years to use it within the business. So due to this liquidity problems, as the company is facing a liquidity problems, that's the only reason the company has put its stadium for the sale and then lease it back in order to release few of the funds so that the company can improve its liquidity situation. Next thing is related to the television program content. This television program content, if one important thing is, I would always say, I always consider that thing, that once you understand your business, you can easily understand the accounting treatment. So whenever a situation comes along with you within the exam perspective, so you need to look into it, what was the main idea of this business. So here another content is television program content rights. So what is a television program content rights? It could be the football matches, those were held by, or those are recorded by Laria company, and for which they have the rights to sell it to the televisions based on the any subscription if the television stations are paying. I hope everyone has seen the recorded matches on the televisions, especially sports channels. So how the sports channel are going to on air all those recorded matches, it could be possible that they might have purchased the content rights from specific individual who have actually contracted, who have actually recorded those and have got their copyright acts or content rights acts from the legislation. Second is Laria company. Laria company has its own subscription-based television station. They have a subscription-based television station. As a result, it had material intangible asset which relate to the content rights associated with the television programs. The budgeted cost of the production are based on the estimated, the budgeted cost, the cost associated with these intangible is the cost, the budgeted cost of production are based on the estimated future revenues from the television programs, and the cost of the production are then anticipated are then capitalized as an intangible asset called as content rights. The directors of Laria company believes that the intellectual property in the content rights is consumed as the customer view the television programs. Consequently, Laria company currently amortizes the content rights based upon the estimated future revenues from the television program. For example, if a television program is expected to generate 8 million of revenues in total and 4 million of the revenue is generated in 1 year, then intangible asset will be amortized by 50% in year 1. Is it clear? The company is amortizing its intangible based on the revenue any item is generating. However, the industry practice, now there's a conflict with the industry practice. However, the industry practice is to amortize the capitalized cost of the programs less its recoverable amount over its remaining useful life. So how industry practice differs? Industry practice differs that within the industry, the rest of the companies or the competitors of Laria company who are involved within the same content rights assets, or who have, when they control the content rights or the intellectual property, they have an amortization, they are charging amortization based on based on the television, based on the cost of the television program, they are going to, based on the cost of that television program or the program, and that should be amortized over the remaining useful life of an asset, rather based on the revenue generated by such content, right? So this is another issue that is that Laria company is facing. The third issue is player contract cost. Player registration contract costs are shown as an intangible asset and are initially recognized at the fair value of the consideration paid for their acquisition. However, subsequently, player contracts are often renegotiated at a cost. Also, player contracts may contain contingent performance conditions where the individual player may be paid a bonus based on their success in terms of goals scored or a success of football team as a whole. These bonuses represents additional contract cost. For impairment purposes, Laria company does not consider that it is possible to determine the value in use of an individual player unless the player were to suffer a career-threatening injury and cannot play in the team. Players only generate direct cash flows when they are sold to another football club. So my question to all of you is, with respect to current issues topic, most of us having the edition of the books until June 2020. How can we get the current issues respective to prepare? Okay, for current issues, I'm just answering this specific concern because current issue is really important. For current issues, you need to go through the technical articles provided by ACCA, or provided on the ACCA website, and for which I have already provided the links of all the articles within the presentation. If you can look into this presentation, what I've shared earlier with you guys, you have all the important article links referred within this presentation. So you can refer those links. This is examiner approach, and these are the important technical articles. Fundamental ethical and professionals principles. With respect to this subject area, there is one, accounting ethics in the digital age. This is one of the important, you can say, current situation which could be faced or which could be tested by the examiner. Financial reporting framework, the concept of profit and loss account and other comprehensive income, and the conceptual framework. These are the two technical articles. Those are provided over the ACCA website, and you can go through all these articles. These articles are not very lengthy articles, and you're not supposed to learn those articles by heart. You only need to go through these articles in order to get an idea what was the current issue and how it can be accounted for. Reporting of financial performance of a range of entities, in which deferred tax is one area, IFRS 2 share-based payments is another area, IFRS 9 financial instruments is another one, IFRS 13 fair value measurement, impairment of assets, measurement, revenue revisited, what does debt seems to be, when does debt seems to be an equity, and cryptocurrencies. I believe this cryptocurrency specifically was tested in March or December 2019, this specific area, the cryptocurrencies, right? So if you go through these cryptocurrencies, and that was, I think, in recent past, you might have seen a lot of news about the cryptocurrencies, the bitcoins, right? So if a company has acquired bitcoins, how the company is going to account it for. I'm not sure what is your idea. Once you go through this technical article, you can. Presentation was already shared, and with respect to Excel file, handouts are already shared within these, you can say, within these today's handout sections. Standard summary was already provided. This is the main summary of Excel sheet, so you can refer those standards, and along with this, you can look into the summary of this Excel sheet. I have shared most important standards and the main idea of those standards within this PDF file. And if you are looking into the handouts again, most probably these are hyperlinked, by the way. How you can look into it, you can see, you can copy the hyperlink. If you find out any problem, you can copy the hyperlink. For example, I'm copying cryptocurrencies, and I'm moving into this address bar and paste this link, and you can find out. Oh, sorry, give me a second. You're going to copy this link, or you can edit this hyperlink. You can find out this is the hyperlink, those are provided within this section, right? So this is the hyperlink. You can copy this one, and then you can paste within the address bar of whatever the whatever research, sorry, search, internet search application you're using. So this is related to cryptocurrencies, right? I hope it is clear to everyone. These were added as hyperlink, but I'm not sure why these hyperlinks are not working. These should work. If you can give me a second, I believe these must have to work. Okay, yes, in the presentable mode these might work. If you are going to click these one, it will automatically open. Within this mode it might not work, but once you are in presentation mode, a slideshow, once you're clicking to these things, you can easily find out. I hope now it's pretty much clear. Yes, this presentation most probably would be available to all of you within the section. I request the organizers to share the link where you can find out all these what I say, all these handouts, and you can easily find out. Yeah, exactly. It most probably it work. It should be working if you are pressing the control button with the and hitting the click button. Exactly. I missed. You might have received an email. Any of the registered participants who are participating in this session, you might have already received an email in which you can find out the link for all these handouts. So you can easily find out. I have already sent those handouts to ACCA team, and they will be sharing those handouts to you. Okay. I hope this is something we are done. Now looking into the next thing with respect of this topic, specific topic, we have discussed three main scenarios here, and now I'll be looking out what is the main requirement. Discuss with reference to the international financial reporting standards whether the directors can classify the stadium as held for sale at 31st October 2005. So first thing is you need to look into the specific requirement of IFRS 5. Laria Company accounting treatment for the crowd barrier improvement at 31st December 2005. So Laria Company had considered the crowd barrier improvement as an impairment. How you can find out that this was considered as impairment? Because Laria Company has actually reduced the carrying amount of an asset, considering that this improvement is somehow an impairment to the carrying amount of the stadium. So it has reduced this value by 2. It has reduced the value of stadium by 2 million. The cost it has incurred for the improvement of the crowd area. That's one. Number third is the principle of the accounting treatment for the sale and leaseback of stadiums. So this specific, the first requirement relates to IFRS 5. This requirement relates to IAS 36 impairment, and this specific requirement relates to the standard that is IFRS 16 leases. For whole these three requirements, you will be assigned with 13 marks, right? So what about the next thing is the B section will ask you a requirement, which is whether the amortization of intangible asset relation to television program content rights by Laria Company and by the industry are acceptable policies in accordance with IFRS standards. So in this section, you will be looking into IAS 38 requirement, whether IAS 38 give you a guidance about how the amortization should be charged on the intangible asset, that is the television program content, how to account for the player's contract. This is the B requirement, how you're going to account for the player contract cost, including the contingent performance conditions, any impairment which might be required to these non-current assets, and whether the player can be considered as a single cash generating unit. So in this specific section, I believe there are two standards, those are testable. What do you think, by the way, how you're going to account for these player contract cost? I'm just giving you an idea. What is player contract cost? There are many football players, or many football clubs. Those are hiring the players, the football players, for a certain period of time. So under which standard do you think? I'm just asking question. You guys, all of you can can answer me within this question answer dialog box that under which accounting standard these should be accounted for. And if anyone is going to tell me, someone has replied that these should be accounted for under IAS 38. So why you're considering that should be accounted for under IAS 38 intangibles? What was the reason? Yes, but for why should be an intangible asset? No, that's not employee benefits, because he is no more your employee. You have contracted him for a limited time period against a consideration you are paying. So it should not be included. Yes, legal rights might be provided within your answer section, but let me give you an idea what intangibles are and how we are going to account those intangibles for. I'm just sharing intangible IAS 38 with all of you, and we'll be discussing how intangible is actually accounting all those assets. So IAS 38 intangible asset, the main objective of this IAS 38 is account for non-monetary assets having no physical existence. So the main objective of intangible asset is to account for only those assets which don't have a physical existence, and those are non-monetary in nature. Is it clear to all of you? They must be non-monetary in nature and they must have no physical existence. So as far as this statement is concerned, if you're looking into the player's contract, the player have a physical existence. So how you can account for that within IAS 38? Yes. Yes, players have a physical existence. So why you think that it should be accounted for under IAS 38? Now, look into the aspect. The company has contracted for the services of the player, not for the player, for the services of the player. So can you identify, or can we assign, or can we look into the physical existence of those services that we have contracted for from the player? We are not concerned with the player. We don't need the player. We are only concerned with the services provided by the player. So services don't have a physical existence. So that's why we consider that as an intangible asset. Yeah, player skills, exactly. Right? And one more thing, if you have any confusion how physical existence should be accounted for, I'm giving you an example. This physical, and to understand the main objective of this standard, this provide two criteria for the recognition of an asset. That asset must not have a physical existence, and secondly, it must be a non-monetary asset, not a monetary asset, a non-monetary asset. So just look into this monetary and non-monetary and the physical existence of that asset. I'm just giving you an example over here. How you can say there is a physical existence of an asset. For example, suppose I'm saying I have a car, and I'm showing one of my friend that this is the registration deed of this car, which was registered with the local jurisdiction, and I own this car because my name was on that registration deed. My friend told me that you might have created a registration deed and you don't have a car. Show me the car. So I can show him the car. This is the physical car that you can see. And along with the registration deed, I have shown my friend that I have a driving license as well, right? I am authorized by the legal authority to drive. My friend told me, no, I don't agree with you, or I don't have any trust in you. Show me where is driving. Can I show my driving? It's a skill. I cannot show him. So the driving that I have, the skill I have, is something I cannot show to anyone else. That means no physical existence. So I hope physical existence is pretty much clear to everyone. Second thing is, there are certain assets, there are many assets those don't have a physical existence. Let's see into the example. I have land available for which I have a deed. Deed is a document that gives right to me that this land belongs to me. I have a machine for which I have a deed. That deed gives me an authority that yes, I have that machine within my control. So all of these assets, a land or a machine, both of these two has the physical existence. But if I'm saying I have a patent and that patent is registered in my name and that for that I have a deed, that patent don't have a physical existence. In the same way, a copyright, again, loan. Do you think loan has a physical existence? No. Loan is just a legal document. It's a deed. It's a signed deed. I have signed it to someone else and I have asked him that, yes, this is the loan I have acquired from you. So if anyone is going to ask me where is the physical existence of the loan, I cannot explain him where is the physical existence. So as far as if IS 38 just explain account for any asset which has no physical existence, in that situation I have to account for this loan even under IS 38. But IS 38 strictly prohibits you that any asset that is non-monetary in nature and that must have no physical existence. If any asset qualifies these two qualities, non-monetary quality and no physical existence quality, only such assets can be accounted for under IS 38. So you can see I am not able to account for this loan within under IS 38. That should be accounted for under any other standard. For the time being, we know that's IFRS 9 financial instruments. But as far as if we don't know what other standard belongs to it, we can easily say loan is not something that should be accounted for under IS 38, right? Any question? Nope, cash. Okay. Do no. Someone asked me, what do you think that cash, either cash has a physical existence or no? I don't think so. Cash is a physical existence. So what do you think? What is cash? You have actually a contract with the central bank of the local jurisdiction, of any jurisdiction. The central bank of that jurisdiction is guaranteeing you that this paper the paper you have is actually giving you a right to purchase any amount, to purchase any item from the market worth this value. So even cash is just a paper, it has nothing. It's this paper has a value because on the back of it, it's a government or it's the central bank that might have signed it for you, that yes, this is the document that 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 has an ability that give you an authority to purchase the value, the equivalent value of items from the market. So cash even don't has a physical existence. I don't think so. Cash is, if the state bank or the central bank of that jurisdiction disown that document, disown that legal document, do you think if there is this that document has any value? No, that has no any value. For example, recently, this is just an example. So everyone must be very clear. This is just an example. Recently in India, most of the currency notes, the big currency notes were banned by the government. So if right now, I'm not sure exactly what the value, what the worth of those documents are, what is the nomination of those documents, but suppose if it's a 1000 document, 1000 note issued by central bank and which is not replaced by any other individual, do you think right now that that document, that paper has any value? No, because the central bank is not going to abuse it. The central bank is no more on the back of that document, so you don't have a value to it, right? So that's why we always consider currency has no physical existence. It's only a contract, it's only an authoritative body that's giving you a right, that's something provided to you. So that's how we can consider that cash don't have a physical existence. Okay, we were discussing about IS 38. I hope everyone is clear what is the recognition criteria. Second thing is recognition criteria was asset definition in the framework, intangible asset definition, it must meet, and the cost of that intangible asset must be reliably measured. How you can recognize it? Initial recognition is more or less based like IS 16 rules. Purchase price, development cost, installation cost, any other directly attributable cost, and if there is any legal fee associated with it, that should be recorded on the initial measurement. You can subsequently measure any intangible asset under cost model or a revaluation model. So cost model is the same one, just like IAS 16, but with a slight difference. If you have recorded any intangible asset under the cost model and the asset has, that intangible asset has an infinite useful life, right? Sorry, it's a finite useful life, then you have to amortize it, and the amortization only starts when the asset is available for use. If any intangible is not available for use, then you're not supposed to charge amortization on that intangible asset, right? So how amortization should be charged? Amortization is charged based on the fair usage of that instrument. It's a fair usage charge. It's an expected usage of that intangible asset. So IS 38 not specifically allow, IS 38 has not specifically allowed or disallowed any accounting for the amortization charge. It just explains that it must be a fair charge compared to the usage of that intangible asset to profit and loss account on annual basis. If it is an intangible infinite useful life asset, you are not supposed to amortize it, but you have to charge impairment on that asset, or you have to run an impairment test on such asset on annual basis. Then if there is an intangible asset which was under development or which was completed but not available for use right now, should also be tested for impairment on annual basis. It's not yet completed, or it's completed but it's not available for use, right? So that's how you can consider that asset. But if there is such asset, then you have to you can say, I would say, you have to impair that asset. You have to test for the impairment. This is something, few of other conditions are mentioned. So we have already discussed that how amortization should be charged to intangible asset. That must be based on cost less residual value. If it's finite useful life, amortizable value in use amortization charge should be based on, it's a straight line amortization, and that amortization should be charged to profit and loss account. And amortization could be based on reducing balance method, could be based on unit produced method, could be based on the R consumed method. So any idea, if you think it's suitable or it's a fair usage charge of that asset, that should be charged to profit and loss account. So that's the main idea of IS 38 impairment. We have written 3 different things about the recognition criteria. One important thing is, if any item that you are going to recognize in your books of accounts does not meet the definition of an asset, it can never be recognized within your books of accounts. So first and most important thing is, if any item you're going to recognize it, if there is any asset you want to recognize it in your books of accounts, it must meet the definition of an asset under the framework. If it's not meeting the definition, then there is no other question that such item can be recorded. Second, what is the definition of intangible asset? Intangible asset are those assets those don't have physical existence, and those assets are non-monetary in nature. Yes, idle asset, irrespective whether it's tangible asset or intangible asset, it must be depreciated and even amortized. Are you getting the point? Idle asset and asset available for use, these are 2 different things. Yeah, exactly. Classification of monetary and non-monetary asset remains same as it was discussed under IS 21. Yes, 2018 framework, yesterday I have provided it, and you can get IS 2018 framework document, the latest framework document, from the link provided by ACCA. Probability criteria was not mentioned here because probability is actually included within definition of an asset. I hope you recall from the framework document, the definition of asset have been changed. It doesn't no more include the probability criteria, and we have already discussed now any asset or liability that should be recorded in books of accounts is now based on faithful representation, and by recognizing that asset or recording that asset or providing that asset within financial statement give you more relevant information, and its benefit exceed the cost you are incurring for providing that instrument within the books of accounts. Now that's the criteria provided by the framework. I think we have already discussed in the very first lecture that yes, there was a conflict, but that conflict was clarified by International Accounting Standard Board, and you might be getting the answer of this specific question within the first lecture. That was, I believe, it was question 1, and it was the last requirement of that question. New framework definition. For any asset you are going to recognize in your books of accounts now, it must meet the new definition. And for that matter, if you want to refer it, you can refer to the second day of presentation to find out how the framework criteria and the standard criteria are actually aligned together. If an asset is unique, then you cannot put that asset under revaluation model, because for revaluation model I'm going to discuss what are the conditions those must met if you're going to put any asset under IAS 38. I'm not sure someone someone asked me that I'm going pretty fast, so I am trying my level best to make sure that I'll be slower going forward. So if anyone has any concern, or if someone feel like I'm going very fast, do let me know. I'll slow down, right? Because this session is mainly for your benefit rather something for myself. So if you think that I'm going fast, apologies if I have not asked in the early classes. If someone find out that I'm going fast, do let me know, I'll slow up. Okay, next thing is subsequent measurement. We have cost model and revaluation model. Under cost model, this is the criteria, those should be mentioned, and I'll be looking into the question after 10 minutes time. So amortizable value is the value cost less any residual value. Residual value is the value that can be received at the end of the useful life of an intangible asset. One more thing, you have to have understand it, what is the meaning of useful life and the actual life of an asset. Just giving you an idea from this section how you can differentiate between the useful life and the actual life of an asset. So for depreciation purposes, you must also be considering that such life. Give me a second. This cost model. So useful life is the expected use life of an asset. There is a theoretical life of an asset. That means this asset can be used for next 20 years. But management has planned to use this asset for the next 10 years. So what would be the useful life? It's not the theoretical life of an asset. It is the expected use of an asset that management want to use it. So you have to depreciate that asset over the next 10 years rather based on the theoretical life of an asset. So you need to consider, we have already discussed in previous classes, accounting is based on the intention of the management rather the actual results. So management want to use that any intangible asset for next 10 years, while that intangible might have a useful life of 20 years. So after 10 years, management is going to discard or dispose of that asset. So once this asset was disposed of after 10 years, what is the expected useful life on the very first day when you are recognizing that asset, right? So you have to estimate what would be the residual value. That residual value should be deducted from here. But normally, intangible asset might not have any residual value. So that's another criteria, that's another understanding. Most of the intangible don't have any residual value. Useful life is how long intention of the management is to use a specific asset. So useful life is always based on the intention of management rather than theoretical life of an asset. So the criteria between IAS 16 and IAS 38 would remain same about the useful life. There should be a consistency between these two standards. So amortization charge is something amortizable value divided by useful life. Right now I'm considering it on a straight line method. So if there's an infinite useful life of an asset, then it should not be amortized, but impairment test must be charged on annual basis under IAS 36. And if there is any intangible asset under development or which was, now one more thing, if you have any concern about available for use and idle asset, just giving you an explanation for that. I believe someone has asked this question. Depreciation should be based if you're looking into why depreciation charge, so it's not based on specifically with regard to the usage of an asset. The depreciation charge is for many of other understanding. For example, the technological advancements within the economy might have resulting into that asset not more useful. So when when the asset was remaining within the company for a longer period of time, it could be possible that asset is going to be, or that asset would be rusted out, right? So it could be possible that there are some damages made to that asset. It could be possible that such asset can be went obsolete in near future, right? So depreciation or amortization is does not include only the fair usage of that asset. It includes many other aspects. So irrespective, if an asset is no more in use, it's idle, you have to have child depreciation, because depreciation is not specific for the economic use of an asset. Depreciation account or amortization account for many other things. For example, obsolescence of an asset or technological advancements within the economy, and there are new advanced assets available for you. For example, for your understanding, I'm just giving you an example. If I have a laptop available with me, and that laptop was the 6th generation laptop, I believe now it's the 10th generation going on. Suppose I would say I have a 6th generation laptop available with me that was I believe Core i7 or whatever that's the system processor was, and there is a hard drive that was HDD, and there was you can say RAMs and all other stuff available installed within the laptop. I'm never using that laptop. Do you think that laptop value remain the same? Purchased 3 years back, I have never touched that laptop, even I have not opened the laptop. But due to the technological advancements, that asset has no more the value that was when I have purchased it. So I have to charge depreciation irrespective that asset remains idle. But important thing is, what is the meaning of not available for use? And second is remain idle. Idle mean you can use that asset, but you intentionally don't use it, or you might not find out some projects to use that asset. Suppose I have developed an intangible asset. I have developed a formula for a new product. For example, I have developed a formula of COVID-19 vaccine. I find out a combination that actually works very effectively in COVID-19 against COVID-19 virus, right? But I don't have the plant right now installed for the mass production. Irrespective, I have the formula, I have recorded, I have recognized my patent, I have recorded that, I have registered that intellectual property name, but as the infrastructure is not available, so I can't use that patent. But once the infrastructure was completed and I had not started the production, I have to start charging amortization once the infrastructure is available to use that asset. It means now this asset, that patent, is available for use to me, but I have not used it on my own. So that's the time when when that specific assets remain idle. In that situation, I have to charge the depreciation. Okay, there are a few other questions. So someone has asked another question. You send the standard summary next. If the software company develop a software, for example, university system, in which universities will either buy the system or unsubscribe by paying annual fee from the respective software company, how the software prototype be accounted for? I believe that software should be, if it's a software development company, then this should be, first thing, that should be accounted for under IFRS 5, IFRS 15, revenue from a contract. If the software development company enter into a contract within the university, that university have given the software company a project that you have to complete that software and deliver to us, then it's no more an asset of that company, that software development house. It is an asset of that university. I'll be discussing that specific aspect within IFRS 15 to show you, to give you an understanding how I'm going to account for it. Second thing, you have mentioned that you have purchased that software, or uh, you have gained a right to use that software by paying a subscription. So that subscription would be a revenue for that software developing house, or the company that has developed the software, and the company has rented it out. So it depends upon the situation. IFRS 16 leases should be applied to such a contract. If the company has entered into a contract with a university, entered into a contract for the use of that software for the next 5 years or for next 10 years, then it should be then that a specific software development house must consider it as a lesser accounting, on the lesser accounting perspective. It's with the perspective of that software house, right? So lesser have to differentiate between an operating and a finance lease depending upon the criteria. So the main criteria is when a lessor can account for any lease under finance lease if the control over the asset was lost by the lessor as a result of that lease contract. Only that is the situation when you can consider that yes, this is a finance lease. In case the lessor holds the control of an asset, in that situation, it's always an operating lease, right? There are certain conditions mentioned within under IFRS 16 guidelines that all of those conditions give you an idea that you have lost the control. Yes, now it's a finance lease. And IFRS 16 simply state that if it is not a finance lease, it's simply an operating lease, right? I hope that question was answered to you. With respect to software house, if the software house has delivered the accounting system based on an annual subscription fee, then that should be considered as a rental income, neither as, or it should be accounted for under operating lease. And under operating lease, you have a simplified accounting, and you can name it as a rental income for software house. The software house has lent out its software to any other university or any other company, and it's earning annual subscription. The annual rent is charging, so that's it could be accounted for as a rental income. I hope it's clear. Right? Okay. Moving to the next one, intangible assets example was cost model is there, and I'm just moving to the revaluation model. Revaluation model, for the application of revaluation model, these three conditions must met. First thing is, you cannot revalue a single assets on its own. You have to revalue the class of assets. Class of assets means any asset with the same nature should be revalued. For example, I have an office, and that office has 10 properties, and the company wants to revalue its one property. Company is prohibited from revaluing only just one property. Company has to apply the revaluation model across all the 10 properties, right? That means class of asset. Second is, there must be a market value or an expert value available. If you don't find any expert value or you don't find the market value of an asset, you cannot revalue an asset, because revaluation is always based on what was the current value of an asset. Then revaluation principle must be applied. The revaluation model must be revisited at regular intervals. What regular interval means? Regular interval means that you have to repeat this revaluation model with the sufficient regularity that the carrying amount of an asset and the market value of an asset should not materially differ from each other. If there is a material difference between the carrying value of an asset and the fair value or the market value of an asset, then it means you have not applied revaluation model in the aspect, in the sense what standard has told you. So these are the three requirements. Now looking into IAS 38 assets, because most of the intangibles are unique in nature, and that's why they have a value. For example, if I told you that I have a piece of paper, why that paper has a value? Because it's unique in nature, right? These are unique notes, you can say, which and no one have. So if there is something unique in nature, only then it might have a specific value. So most of the intangible, as they are unique in nature, you cannot apply the revaluation model to most of the intangible assets. But this doesn't mean that revaluation model can never be applied to all the intangible assets. Any intangible asset that is meeting these three criteria can be placed under revaluation model. Is it clear? And revaluation rules applied in the same way, just like IAS 16. So there is no change in the rules. Only you need to make sure even these rules still exist for IAS 16 assets. But in this case, you are revaluing an intangible asset, but under IAS 16, you are revaluing a tangible asset. So that's the only difference, nothing else. What is part of licensing? I'm not sure. No, it's not part of licensing. You can say you have given out a license and you're charging for that license, but most of the time you can say it's a rental income. I'm not sure if you are asking about with respect to a party who has taken that software, or the party you are talking about who has delivered the software. If a party has delivered the software, for that party it could be a licensing income or a rental income if the renewal is based on annual basis. If renewal is on annual basis, then it should be a rental income or licensing income, whatever name you suggest better, right? It depends on situation to situation. Second thing is, with respect to the company which is paying the subscription, that a company has acquired the software for paying the subscription. If that company has acquired the software under for a year time period and the contract renews every year, then it should be a you can say it should be a rental expense under IFRS 16. It's a simplified accounting, right? But if lessee has acquired that software for more than a year, and the asset must have a material value associated with it, then you have to account for it under the lease contract, right? You have to calculate right to use asset, you have to calculate lease obligation, and then you have to do the rest of accounting with respect to that asset. But it depends upon the situation. But as far as I am concerned, it should not be accounted for under IFRS 15. It can never be accounted for under IFRS 15. Yes, IFRS 15, if it is the principal activity of the company, that it's a software house and it's only sell the software to the companies, then yes, it is a revenue for the company. But it's always an income. If it's not the principal activity of the company to rent out the softwares, then it should be accounted for under the head of other income. It should not be accounted for under the head of revenue within the income statement. Are you getting the point? So it's depending upon the situation, it must meet certain conditions to account for under a specific standard, right? I hope this question was answered. If still you have a question, do let me know. I'll be answering the question again, but that's the main criteria. So we have studied IAS 38 criteria. Now moving to our question. I hope no one has any further questions. So I'll be moving to, oh sorry, we need to discuss stadium for leads. Oh, okay, sorry. First we were discussing about why we are including the contract of a player as intangible asset. So I hope everyone has understood that contract is for the services of the employee. So that's why we have to account it for under the IS 38 standard. So looking into the answer, first thing is this stadium is, what was the requirement? What the first requirement? The first requirement was whether director can classify the stadium as held for sale or not. In this scenario, the company Laria has planned to sell that asset. Laria company entered into contract regarding its stadium whereby it will sell the stadium on 30th November 2006 and immediately lease it back. So as far as 31st of October 2005 is concerned, I'm pretty much sure that on this date the company has already entered into a contract, so it's a sure short sale. But yes, as the company has entered into a contract, on the basis of that contract, the company is going to sell its stadium to any of the company, to any other organization, to any other business on 30th November. So yes, the sale is highly probable within the next, I believe, within next a year time period, right? So the company could account it for under IFRS 15 as far as what I understand, but I believe even in that criteria, it's not meeting IFRS 15, IFRS 5 criteria. Management is committed to the sale. In this case, yes, management is committed to the sale. Management is going to sell that assets in its present condition. There is nothing mentioned that management is going to make any amendments to the stadium. There is nothing mentioned here. Third criteria is, or the fourth criteria is, if the management is committed to the sale, then the price should be charged based on the market value, a reasonable price. So it's always charged by the management. So this is also meeting the criteria of IFRS 5. Another condition is management is actually actively looking for a buyer. Management has actually located a buyer who is willing to purchase the asset, and it is highly probable that sale would be done in the next 12 months. So I believe yes, sale would be done in the next 12 or 13 months. So as far as IFRS 15 is concerned, most of the criteria of IFRS 15 have been justified in this situation. What do you think? Should we place this stadium as a non-current asset held for sale under IFRS 15? But once we are looking into the contract that was signed by Laria company with any of the supplier, that provide you another insight into this transaction. This transaction is actually, Laria company has not just sold the stadium. Laria company has also committed to lease it back. So if such situations comes in, this specific situation should be accounted for under IFRS 16 leases, rather IFRS 5. So you cannot place stadium as a non-current asset held for sale under IFRS 15, irrespective of all the conditions have been met, because this situation should be specifically tested under IFRS 16. So you have to apply IFRS 16 rather applying IFRS 5 to this specific asset. Is it clear to everyone? So we are not going to place this asset. I'll be looking into the answer, but first we are answering this requirement. Can we place this asset? First you need to explain either we can place it or not. But as far as the discussion is concerned, I think yes, we can place it. But if we're looking in insight of the looking into details of the insight of IFRS into the details of the contract that was signed by the Laria company, that contracts actually give you more insight and that give you an idea under which standard that should be specifically accounted for. So this transaction should be accounted for under IFRS 16 leases rather IFRS 5. So that's the main idea. Next is Laria company accounting treatment of the crowd value improvement as at 31st of October 2005. So first we need to understand what Laria company has actually done with these non-current assets. So with the area, with the improvement of area, what area that is? It's basically crowd barriers, right? Where the crowd or where the those who want to see the match, sitting area of those individuals was concerned, those barriers were improved. So if you look into it, the market value of this stadium type is not yet 7 years. In the near future, the stadium is being depreciated 5% per annum using straight line method. In the year ended 31st of October 2005, it is anticipated that 2 million will be spent to improve the crowd barriers in the stadium, right? The company Laria has spent 2 million. That company has estimated, it is anticipated that 2 million will be spent to improve the crowd barriers in the year ended 31st October 2005. And but as far as this is concerned, there is no legal requirement to improve the crowd barriers. So there is no legal requirement, there is no specific guideline provided by it, or there is no implications on the Laria company to improve. The company might have improved to make sure the stadium looks more nicer to the audience, and audience will be visiting this space more frequently for watching the matches, live matches, and there could be any other thing. The Laria company has incorrectly treated this amount as a reduction of the assets carrying amount at 31st of October 2005. Now, I have two ideas as far as this question is concerned. I'll be looking into the answer. I'll be discussing the answer with you. But right now, what my understanding is, rather capitalizing it, the company has expensed it out and charged to profit and loss account, this specific 2 million, right? But as far as this is concerned, this is not the impairment. There is no legal requirement. There is no obsolescence of an asset. There is nothing happened to the old barriers, but company has made some improvement to the barrier. There is no legal requirement. There is no legal restriction on the Laria company that it cannot allow the participants or not allow the audience to sit within the crowd area without placing the new crowd barriers. So if that is the case, that could be considered as, and if this is an improvement, it can never be considered as an impairment, and it should not be charged as an expense to profit and loss account, because we always considered what amount should be charged to profit and loss account if it is a repair to the barriers. It is not a repair to the barriers, it is an improvement to the crowd barriers. So this improvement word give you an idea that it must be capitalized, right? But as far as this is concerned, this specific the next line is concerned, it's mentioned within the question that the Laria company has incorrectly treated it and has reduced the carrying amount of an asset. That is, it have charged that capitalization of that item to the profit and loss account, right? And at 31st of October, the carrying amount, and the company has already, this is not something it's charged to profit and loss account, it was already charged as an impairment to profit and loss account. You can see here, this cost is going to incur in future in the year ended 31st October 2006. It is anticipated that Laria company might need to spend this amount in the future in order to improve the crowd barriers. Right now, the company has not actually incurred that or not actually spent this 2 million. The company is going to, has anticipated that's going to charge within the next year, right? But in this year, the company has considered that the crowd barriers might have been impaired, and the impairment charge was applied to the profit and loss account in the same year. So one thing, we have to reverse this. Second thing is, at 31st of October 2005, the carrying amount of the stadium after depreciation reduction of the crowd barriers improvement is 18 million. So you can explain that this is not the correct treatment. And one more thing, it is anticipated in the future, and there is no legal requirement for the company to improve the crowd barriers, and hence this should not be considered as an indicator of improvement. This is something company is planned, Laria companies has planned to improve the crowd barriers. Rather, there is any problem with the existing barriers and those were replaced. If that would be the condition, if the company need to replace those crowd areas within next year, then it should be considered as an operating expense. That is not an impairment even within this year. But if that is the case, that these crowd barriers are no more usable and they are against the health and safety rules provided by the regulators, and the company must have to replace those because few of the barriers are outdated, or few of the barriers have resulted into injuries to the participants, to the crowds, to the individuals who are within the crowds. So that's why the company has imposed a penalty on it. The regulators has imposed a penalty on Laria company and asked them to improve it. Now, in this case, this is an indicator of impairment that shows that the crowd barriers are not up to the mark as per the legal requirement. So I have to charge the impairment and I have to consider the new one. But that's not the case. It's just an improvement in that is just based on the intention of Laria company rather than any legal requirement or any other constructive requirement. You can say there is no constructive or legal obligation of the company for the improvements. It's something, it should be considered as either an future operating cost. So operating cost can never be charged to the profit and loss account immediately until and unless that has been incurred, right? And as this is an improvement, that should be capitalized even in future, and that should be depreciated over the remaining useful life of those cloud types, right? So this treatment done by Laria company is incorrect. So what about the next requirement, the third requirement? This, I'm looking into your question if there is any further. So yet if there is a legal requirement, then it should be recorded as a provision. Yeah, exactly. But as far as I understand, the company might have entered into the contract, and this could be the time which is after the reporting date, and after, if that's after reporting date, then you have to consider it. But that is the only requirement. That is the only requirement. Someone has told me that this 30th November 2006 was after the 13 months. So the main requirement of IFRS 5 is it's highly probable that this sale should have been occurred within the next 12 months, right? Irrespective. Now, one more thing you need to understand. Under IFRS 5, if you have placed an asset which is held for sale and all the requirements were met, but company was unable to sell that asset for the next 2 years or 3 years, but at the end of the third year, even if all the conditions are met, you have to place that asset under IFRS 5 non-current asset held for sale until and unless there is one condition that does not meet. And one important thing is, if all of these conditions met, you can easily expect an asset to be sold out within the market within the next 12 months, because there are willing buyers always available, those plan to buy those assets, right? So I agree with you, this is 30th November, that is more than the 12-month expected period. But as you enter into a binding contract with another party, so I guess that we can consider a little bit of relaxation to this specific requirement. But yes, this is based on your judgment. Another idea. So as far as my judgment is concerned, I consider that as there is a binding contract, so I consider that yes, this asset is already sold out. The company has already found out a customer, right? Company is not finding out the customer, is not locating the buyer. It has already been located, and the contract was signed, and the sale transaction was highly probable. So yes, company can place this asset under IFRS 5 non-current asset held for sale, because all the conditions are already met, irrespective it's a 12 months, just one condition was not met. But even if you're looking into that condition, we can consider that condition was already met, right? So we can place that asset under non-current asset held for sale, because I have intended to sold out that asset. Is it clear? I hope I have answered this question. But you can mention yes, strictly speaking, because it's all about the intention of the company. If you're strictly speaking that I have to follow 12 months criteria, you can suggest an answer to the examiner. I'm not going to place this asset under IFRS 5 non-current asset held for sale. Why? Because the 12-month criteria was not met, irrespective all the rest of criteria were met. Even that answer was correct. No one is going to incorrect it, right? Yeah, exactly. Immediate sale should never be recorded under accounted for under IFRS 5 non-current asset held for sale. Held for sale means it is held for sale. Yeah, exactly. It's all about justifying your answer with logical comments. If your comment makes sense, then examiner is going to accept your answer. That's something I've already mentioned in my previous sessions. No answer is correct. No answer is absolute correct in the, for SBR exam. No answer is absolute wrong under under SBR exam. So as far as you are justifying your answer, examiner is going to give you the score, right? So that's depending, because when you would become a professional accountant, it's your judgment for the accounting. You make your own judgment and you consider that my judgment is correct. But while when auditor is doing the audit or performing the audit, he is giving another judgment, and he would be, if the auditor convince you, then you have to follow the treatment suggested by the auditor. But in reverse, if you have sold your idea to the auditor, then auditor will always agree with your treatment. The auditor is not going to reject your treatment. So it's all about your judgment, right? So it's basically based on the judgment idea, how you judge a situation. Secondly, how the guidelines of specific guidelines provided by international financial reporting standards, like the interpretation committees have given you an idea, so you have to consider those specific guidelines under provided under SIC standards interpretation committees, or IFRIC's international financial reporting interpretation committees. So that those situations should be followed as mentioned in the question. But still, as not all the situations have exactly the same circumstances, there are different circumstances for even a single sort of situation faced within two different companies. So the justification or the understanding of two accounts is always different, right? So this paper is basically based on how you are going to justify your answer. It's all about your justification, but you need to make sure you are applying the standard in a sense those standards are, right? So that's one idea. Oh, okay. I think we have discussed two main ideas of this question. The third criteria is the principle of the accounting treatment for the sale and lease back of the stadium at 30th September. So if you have an idea of sale and lease back, so I'm moving to IFRS 16 leases standard, and I'm looking into specifically what sale and lease back actually means. Yep, this is, I believe, sale and leaseback transaction. It's sale and leaseback transaction. So sale and leaseback transaction always consider that the seller has sold out portion of the asset, not the whole asset. That's one criteria, right? And secondly, as the seller who would become the lessee as a result of this at the end of this contract, one thing you have to consider whether the sale you have made meets IFRS 15 criteria, revenue recognition criteria, then yes, you can consider this as a sale. And then only the lease contract comes in. This is the second part of the contract. The first part of contract always give you an idea whether it is a sale under IFRS 15 or not. If transferring an asset under the sale and lease back contract is sale under IFRS 15, only then it can be a lease transaction. If the transfer of an asset is not a sale under IFRS 15, then the amount you have received is considered as a secured loan. You have pledged your non-current asset against the sum of amount you have received. So how we can find out that whether it's a sale or not? So we have to look into IFRS 15 criteria now, right? So what IFRS 15 criteria is mentioned, I believe you have always you might have looked into the fifth step of revenue recognition criteria, that when you can recognize the revenue, you can recognize the revenue under two models. One is at certain point in time or over the period of time. So this criteria should be met under this should be considered to be as the criteria of revenue recognition at a point in time. So I'm looking into at a point in time criteria, and this I believe is the criteria. Revenue recognition of revenue when performance obligations are satisfied. Revenue recognized once performance obligations are met. You can only recognize the revenue once your performance obligation is met. You can either recognize the revenue over the period of time or at a point in time. But main idea is when the control on the asset was lost by the supplier. So main idea is when you are losing the control, it means now you can recognize the revenue against such asset. So I'm not looking into over the period of time, I'm looking into at a point in time. At a point in time criteria, how at a point in time criteria should be assessed. So first thing is the supplier has a present right to the payment for the asset. Once the supplier has established his right, that right now I have a right to receive the payments, then it means that it is a sale. Second, the legal title of an asset is transferred within the customer's name. It also constitutes the sale. This is one of the most important criteria. The customer has a physical possession. If the customer has the physical possession, it means it is a sale. So at a point in time criteria for the completion of at a point in time criteria, this fourth point you have to have considered always when the significant risk and reward of ownership of an asset are transferred to the customer only in that case, and at what point those risk and reward of ownership have been transferred within the customer name. That's the point where you can recognize the revenue and the customer has accepted the product or the asset, then you can recognize the revenue. Now looking into this scenario, what do you think whether these criteria have been met or not? If you're looking into it, this asset was made at a market value. Now, one more thing, I think this is sale and lease back, repurchase. This is something criteria of repurchase agreement. If these conditions are met, then you can say that it's the repurchase agreement. So repurchase agreement means it's a secured loan, it's not a revenue. When you have sold an asset below the market value, have we done the same thing over here? The sale contract requires the disposal of a stadium for its market value of 30 million. So you have sold an asset at its market value. So it means it is not a repurchase agreement from the very first criteria. Now looking into it, repurchase below the market value. Have you any option to repurchase this asset or lease out that asset below the market value? That's not the case. The present value of the lease payments at market rates, are you considering the idea? So as far as these two criteria is concerned, I'm pretty much confident that this is a sale under IFRS 15 because it's not a repurchase agreement, it is a sale, right? And once the criteria of sale has been met, it should be accounted for under now IFRS 16 because IFRS 15 criteria have been met up to this point. Is it clear to everyone? I'm reading out the other one. Supplier is using the asset right now. Yes, this under repurchase agreement, you can say whether it is this asset was under the use of the supplier. Yes, it is under the use of supplier, but now against the amounts the supplier is paying for. So it's no more an asset of the supplier. Second is majority of the risk and reward of ownership belongs to the supplier. Do you think majority of risk and reward associated with the stadium belongs to the Laria company? No, because Laria company don't have any obligation to purchase this asset at any specific market value in future. If the market value of stadium loses or drops down the fair value, then Laria don't have any loss in it because Laria have to pay this lease amount for the next 10 years and use the asset irrespective of what is the value of that stadium. If the value of stadium increases, then the benefit goes to the customer, though that the customer that have purchased the stadium and then lent it out under the lease contract to Laria company. Sale is made to the financial institution. We don't find any information within scenario that this sale was made to any financial institution. Right? Any confusion? Right now, it's not a leasehold asset. The question someone has told me that it's not the leasehold asset anymore. Why? The lease contract started or was initiated from 30th November onward. It's not applicable right now on 31st of October 2005. Even it is not applicable on 31st of October 2006. So till 30th November, this stadium is the asset of Laria company. So Laria company must have to charge depreciation over the remaining useful life of an asset or over the reducing balance method what was prescribed here. Done? Why IFRS recommend incremental borrowing rather than effective rate of interest? Incremental borrowing rate. I don't understand where this incremental borrowing rates was mentioned. I don't have any idea. Apologies, I don't get this question. If you can explain it further, that was why IFRS 15 recommend incremental borrowing rates rather than the effective rates on interest. Specifically, I don't get the point. If you can rephrase your question or specifically telling me what you actually mean so I can better explain to you? Apologies, that's something I'm not getting, right? Okay, I'll be looking into the questions later. Now I'll be moving on with, I hope you have understood that how this should be accounted for, and as the examiner has provided you much details of it, so you can perform the double entries even in this situation. How you can perform a double entry? You can make a double entries of sale and lease back transactions. So if you are going to sell it out, you can find out what are the sale proceeds. What are the sale proceeds of this asset? Sale proceed of this asset is, I believe, 30 million right now. Why 30 million? This is the fair value, and how you can identify held for sale on 30th of October. The sale contract required the disposal of stadium for its fair value of 30 million. Right now, once you are entering into the contract on 31st of October 2005, 31st October 2005, the value, market value of this asset is 30 million. But when you are going to deliver the control of that asset on 30th November, more than a year in future, right? So you have given another statement here. The market value for a stadium of this type has not changed in several years, and it's unlikely to change in near future. It means this 30 million is the market value that would remain same after another year or another year, right? So I'm considering it sales proceed on the in the future date when the contract was actually involved was 30 million. Got the idea? So if the 30 million, this value is the cash you're going to receive in future, you have to recognize what was the net book value of asset at what date? At 30th November 20x6. Because on this specific date, the contract was effective. Before this date, this contract was not effective. This is just a contract, a binding contract. The control of the asset or the rights of the asset, the rights of ownership of the asset would be transferred to the other company on this date, not right now. So what would be the net book value? Right now, the examiner has provided you at 31st of October 2016 the carrying value of the stadium after depreciation and deduction of the crowd barrier improvements was 18 million. This is the 18 million. So right now 18 million is the value, right? Sorry, I'm looking into the value on 31st October 20x5. This is carrying value of stadium. Oh, sorry. I'm just shorting it down, stadium, right? So the carrying value of stadium 31st October 2005 is one, it's 18 million, right? On top of it, the 2 million value that you have charged to the profit and loss account, we have to add it back because this is the wrong treatment, right? So what would be the depreciation that should be charged for the next year? The depreciation charge for the, sorry, depreciation for the year ended 31st October 20x6. What would be the depreciation? This depreciation should be this 2 million multiplied by 5%, right? So this should be the depreciation. So if this is the depreciation, what would be the net book value or carrying value, you can say, or carrying value of stadium on 31st October 20x6? That value would be 19 million, I believe, right? Sorry, minus. I need to minus it, right? But you have to amortize it for another 1 month, and I'm considering it that the amortization charge is on proportionate basis. I'm not sure if there is any other mention, any other information mentioned that amortization should be charged on proportionate method, not any other principle. So I'm considering it. So depreciation, sorry, amortization, it's amortization. Apologies, this is, should be amortization. You need to be mentioning in your exam as amortization rather as depreciation, right? So amortization of 1 month, how much of the amortization should be charged in 1 month? 19 million multiplied by 5% divided by 12 multiplied by 1. So this is the amortization that should be charged for a single month. So I'd be considering the net book is this 19 million minus this another value. So it's 18.922 the whole value which was mentioned here, right? So this is how I would say it's 19 million. So this is how you can account it for. What is right to use asset here? Right to use asset. To calculate it, the right to use asset, you need to make sure how much of this fair value you are paying back. So you are paying back 26 million out of this 30 million. So how much of this carrying value you are retaining within this? You need to find out the percentage. You are paying 26 million divided by this 30 million. This is the percentage you will be retaining the value of an asset. So how much is right to use asset? Right to use asset equals, you have retained 87% of this 19 million, which is 16.3098 million. Is it clear to everyone? Or 16.4 million. In short, I'm saying it 16.4 million. Now you need to make a double entry, right? So what would be the double entry? So lease obligation would be, or present value of lease obligation would be 26 million. So I have all the information available. I need to make a double entry, a debit and a credit entry, debit and credit. Debit should be, you have received the cash, right, for the disposal of that asset. How much cash you have received? You have received 30 million. Against this cash, you have disposed of your asset, which is stadium. And what is the carrying value of an asset that you have disposed of? Its value is 19 million. So this is the debit entry and this is credit entry. Now you need to account for the lease contract. This is the sale proceeds of the contract. Now you need to account for the lease contract. For the lease contract, you have to record right to use asset, and the value of right to use asset you have calculated as 16.4 million. And you have also need to also record lease obligation. What is the present value of lease obligation? It's 26 million, right? The balancing figure is always gain on loss on disposal of this stadium, right? I believe gain or loss should be recorded on which one side? It's I believe this debit side is higher, so we have to make some adjustment on the credit side, which means gain on disposal of stadium. So what is the gain on disposal of stadium? You can account it for this 46 million minus this 26 and minus this 19. So it's round about 1 million. If more precisely I'm looking at it, it's for 1.477 million or 1.5 million, more precisely. Any confusion or concern, you need to explain it in your own words once you are answering the question. So I'll be looking into the answer. I'm looking into, okay, that's a very good question. I'm looking into the question. I think we move a bit fast to cover more topics. It's break time. Yes, it is a break time. I'm looking into it. Is it on reducing balance method? Yes, it is on reducing balance method. You can see here, this is something. The stadium is being depreciated 5% per annum using reducing balance method. So I hope this one thing is clear. So next question is, give me some time. I'll be looking into the question. Will you please repeat right to use asset? Yes, I'm going to repeat right to use asset. How to get it 7%? You'll be 87% value would be found out if you are looking into. I'll be getting back to the other questions, but right now, right to use asset is what? Right to use asset is the amount you are paying, the present value of future lease obligation. You're going to pay against the amount or against the current market value of an asset. This is the current market value of an asset, and out of this current market value, you committed to pay this amount. It means out of this 30 million rights, you have attained 26 million values right. Out of this 30 million value rights, you have retained 26 million rights. And as far as prudence concept is concerned, you're not supposed to overstate your asset. You have retained out of this net book value. You have not purchased something new. You have actually retained from this net book value of an asset. So if you are recording this 26 million as right to use asset, you are overstating your asset. Because in this scenario, you actually don't have purchased a new asset. You're looking into substance over form. Substance over form means what? The legal nature of a transaction, then economic nature of a transaction. What is legal nature? Legal nature is you have sold out the asset, but economic nature is you have not sold out the whole asset, you have sold out the portion of an asset. Just because of the nature of the asset, you cannot break down the stadium into portions, right? You have break out its useful life into portions. You are using the whole stadium with you, but you have retained the right to use this asset for a lower time period and sold the rest of the time period to any other party. But you have to have retained out of this value, because economically you have not sold out the whole stadium, you have just sold out the portion of the stadium. Is it clear to everyone? So if anyone has a question how to get 87%, I believe that would be answered. And someone asked me, sir, I don't get why not to take right to use asset as 26 million. I hope I have answered this as well, but still if there is any confusion, do let me know. And right to use asset, I have calculated once again. I have attempted IFRS 15. So what's the problem? IFRS 15 question in which given two rates, implicit interest. It should be IFRS 16, implicit rate of lease and incremental borrowing rate. Borrowing rate, that is, I'm not understand behind the logic. It should be IFRS 16 question. Someone has asked a question that IFRS 15 question in which given two rates, implicit rate of lease and incremental borrowing rate. So this should be leasing related question, and leasing related standard is IFRS 16. I'm going to explain implicit rate of lease and incremental borrowing rate. Apologies, I believe you were trying to mention IFRS 15, but by mistake I believe that was typed IFRS 15. IFRS 15 is revenue, IFRS 16 is leases. So under the lease contract, there are two rates provided. One is implicit rate of lease and second one is incremental borrowing rate. I'll be discussing right now after this one. I hope this is clear to everyone. If right to use asset or why we are not considering this 26 million as right to use asset, if anyone has any question or concern, do let me know. Today I'm not going through this question, the answer of this question, so you can read it out. I'll be taking a break for 10-15 minutes. You can read out the whole A section 1, 2 and 3, and then if still any confusion, do let me know. I'll be answering the question. I believe this is something, it's 1.4, it raises gain on disposal, so we have correctly calculated it. You can just go through this question, and if you still have any concern with respect to this question, do let me know. I'll be explaining it, but I hope I have covered the most important aspect of this question, and now you can easily understand why the examiner has mentioned anything within the question requirement, right? So if you are looking, Noan, if you are looking into the incremental and implicit rate of leases, implicit rate of lease, implicit interest rate of lease or implicit rate of lease, and differentiation between incremental borrowing rate, so it's rather better to use an implicit rate of lease in priority, because implicit rate of lease is the rate of return that a lessor require or a lessor wants, right? When the lessor is leasing out you an asset, he must have calculated his own rate of return, what he is expecting, and based on it he is going to charge you the interest, right? Is it clear to everyone how implicit rate of lease should be accounted for? It is the rate of the lessor. Now you are being a lessee, you have acquired the asset in the lease contract. Most of the time you are not able to find out what is implicit rate of lease, because it's something, a confidential information for the lessor, and lessor is not going to disclose this information to you, right? It's a business secret, right? So if in most of the cases you are not provided with implicit rate of lease, most of the time you are provided with incremental borrowing rate. So what is incremental borrowing rate? Incremental borrowing rate means the interest rate on which you can acquire the new loan, because once the company's gearing has been increased, a business gearing has been increased, the business is unable to obtain the loan at a lower interest rate. The interest rate should be higher compared to the previously acquired loans. Why? Because the company is now the company is more risky compared to the previous situation. So any lender who is giving you an extra loan should be charging you an extra borrowing. So once you are using the discount rate for the present value calculation, you must be using in priority the implicit rate of lease, which was actually charged by the lessor, because lessor better understand what is your risk position, right? But if the lessor has not provided you that rate, that information, then you must be using your own idea what would be the incremental borrowing rate for us. Because if this asset was not lent to me under the lease contract by this lessee, by this lessor, I have to acquire this asset by getting a loan from any bank. So that rate is more appropriate, but in first priority, implicit rate is always the most appropriate rate that should be used, and that should be used in priority compared to incremental borrowing rate. I hope it's pretty much clear. If still confusion, do let me know. I'll be discussing it once again. Right now, I'm going to have a break for a few time, and once I'm back, I'll be quickly looking into these two aspects of television program contract and peer contract cost. So to wind up this question very quickly, and then I'll be discussing IFRS 9. I'll try to make sure we'll be going through the main aspects of IFRS 9 as you guys have told me, and we have looked into most important aspects of IFRS 15 as well as IFRS 16 right now. But still, if anyone want to clarify any other portion of IFRS 15 or IFRS 16, do let me know. Otherwise, I'll be looking into IFRS 9 once we are done with this question. So we're going for a break for like 10-15 minutes, and then we'll be back and we'll be discussing the rest of the two sections of this question, right? And if someone has any question in between, drop a question, drop your question within this question section. I'll be answering it. Okay, let's back. There is one question, F2, press F2 as right to use 87%. So this is the formula for right to use asset, 87% calculation. I believe right to use asset 87% calculation would be, this is the formula. Is it clear to everyone? 26 million for this right to use obligation divided by 30 million of sale proceeds, the market value of an asset, multiplied by 100%. You need to make sure right to use asset should always be calculated with respect to the market value of an asset, rather with the sale proceed, because within SBR, you guys might be finding out the sales might be done for more than the market value or lower than the market value. So those have a different treatment. As far as right to use asset is concerned, you have to calculate right to use asset based on the market value of an asset always. Okay, exposure draft. I'll be asking the organizer to add those exposure drafts. I have already sent it him, and he's going to attach those exposure drafts within some time. Most probably in 10 to 15 minutes, those exposure drafts will be available in these handouts section. Most probably in 10 to 15 minutes, I'll be communicating to him. So as there is a limitation of documents attached to this section, so he might be removing the existing attachments, handouts, and he'll be attaching the rest of exposure drafts within this section. Guide, analysis, and management commentary. Management analysis and management commentary is an important topic. That analysis and management commentary is basically something the management has added discussion on any of the aspect of the company's position, performance, all the financial statements. The management commentary, or the management has commented on it, how the company has performed, what is the future plan of the company, and how company would be expecting to move in future. Next question is accounting treatment, demolishing cost of an old building to construct a new building. So as far as this situation is concerned, if you are considering demolishing cost, I believe this demolishing cost should be accounted for as a capital expenditure for the new building. Why this should be accounted for as a capital expenditure for the new building? Because it should be included as an expense, or as an expense of a site preparation for the new building, right? So the company was using old building as an admin block for several years, now demolishing and constructing new building for production purposes. So you cannot develop the production facility without demolishing the other one. That demolishing process could be considered as a site preparation process. So if you have incurred any cost in order to prepare the site for the development of new asset, that site preparation should be capitalized. If someone has a problem, so I'll be opening up IS 16 where you can look into it, that any site preparation should always be capitalized, should be considered as a capitalized expenditure, right? So this site preparation. So if you need to demolish it, I believe it should be capitalized. And as your opinion is concerned, I agree with this opinion. Last thing is, yes, as far as this stadium is a non-current asset for the company, it should be depreciated over the time period until 30th November 2006. It should be depreciated, and we have calculated depreciation in the same way. No, I was not speaking at that point of time. My microphone was, my speaker was off. I believe cash flows of Forex is one of the important aspect of your syllabus, and I believe if it was not tested for cash flows, it might be tested for consolidated financial statements. So that is something, my expectation is that not something 100%. This should not be considered as a guess. This should be considered as just an understanding, and we should be considering it. And I have multiple machines, and I am Following revaluation model, in the current year I have purchased specialized machine. Still we have to follow revaluation model for all of the machines. Yes, you have to follow the revaluation model for all the machines, even the specialized machine. But if you are unable to find out the market value of that specialized machine, then you can place that specialized machine or a cost model up to the point when you find out the market value of that asset. So this is an exception available to you, right? But you have to treat that specialized machine under the revaluation model up to the time period when you are not able to find out the market value. You can put that machine under the cost model, but only up to that point in time, until you find out the market value of that specialized machine. I hope that's clear. This 2 million has no other impact. One is increase in the value of an asset, and second one is reversal of expense that we have already recorded in your profit and loss account. What is the name of the company? And why I'm always referring the name of the company, because whenever you are answering within the question, make sure you are referring the name of the company. That's how you can create a linkage between your answer and the examiner requirement. So Laria company, as Laria company has expensed out the 2 million profit and loss account by reducing the value of an asset, so you have to reverse that entry. It means you have to debit your asset and credit your profit and loss account. So if you are crediting your profit and loss account, it means either you are reversing your expense or you are recording an income. So in this case, you are actually reversing an expense that was already recorded. That was incorrect entry. Asset ceiling was already discussed in the previous session, so you can go through that recording. I believe the recording was available, and there is one email shared by the organizer, and I'll be sharing that email with you guys. That email is give me a second. That email is customer services pakistan@accglobal.com. So I'm mentioning here, this is customer services dash pakistan@ACCA global. This is the email that you can refer for customer service. You can refer for all the handouts for the sessions, and all the recordings will be sent to you over the email, so you can refer those. Asset ceiling was already discussed. Can you explain the current issues in last 1 hour? Current issues are related to your all the topics. Those are mentioned within the technical articles I have discussed. It's a huge area. So while going through all the current issues, it's not possible that we can look into this specific aspect within 1 hour. And frankly speaking, it's pretty easy. If you are looking into your technical articles, you will find out pretty easy to understand it. I have also shared the WhatsApp group. If you have any concerns with respect to a specific portion, I'll be answering over that group once I got the time. So this is not commitment that I'm always answering the question in time, in real time process. I'll be answering once I got time to all the questions you'll be sending out on that group. I have actually replied on an email, all of you. I'll be mentioning that email once again. This was mentioned to one, I believe. I need to copy it. I think I have sent it to the clipboard. I'll be sending this question to everyone later. Email would be sent it to no recording available. Recording will be available as the organizer might have answered you from where you can get your recording. So every time you'll get a link in WhatsApp group, you will also be shared with you the link of WhatsApp group. Yes, I have already created, and the link was sent you by the organizer. Yes, you need to read out the exposure drafts and the discussion paper. There are 3 exposure drafts and 1 discussion paper. And along with it, you need to read out the framework document. And with all these, once go through the technical articles. That was more than enough for your current issues aspect. So the carrying value of old building should be charged to profit and loss account immediately, as you can say, as an impairment. I have already shared those within the handouts, and you'll be receiving. I'll be sending a message to the organizer. He'll be attaching those exposure drafts with this within the handouts section. Juved. Walaikum salam. Mike. So everyone, apologies. I don't understand. My mic was off, and I have already added up the within the handout section exposure drafts and discussion papers. You all of you can download those handouts and this exposure draft from that section. Apologies once again. So these are the exposure drafts. As I have shared with you, this is the exposure draft accounting policy changes, proposed amendments. One is related to IAS 8. Second one is related to deferred taxation, IAS 12. And this third one is related to few of the standards that I'm going to share those main parts. So these are the standards to which this is related, right? This mainly require a proposal was placed to change IAS 1 with the new standard, and these are the other standard, though amendments to those standard was were recommended, were proposed within this exposure draft. Next one is discussion paper. This discussion paper is basically related to financial instruments with the characteristics of equity instruments. You can go through these documents. These are almost, you can see here, this is a 150-page document. I don't ask you to read out or go through the whole 150-page document. I'll be going through this discussion paper, and I'll be sharing within the WhatsApp group that which specific pages you need to focus on. Rest, these exposure drafts, you can go through the whole exposure draft. These are not in much detail. You can just go through into the basic ideas of these exposure drafts. Right, so still there is, if any question, do let me know. And apologies once again. Yes, I know my mic was off, and These should be tested in your current section, and it's not the case that the whole exposure draft was tested. There could be one or two main aspects of those exposure draft that the examiner might ask you. So you have to answer it in light with what you have in your mind with respect to this exposure draft. Once you are reading out those exposure draft, you can easily understand those exposure draft. Idea means you need to understand what was mentioned within this exposure draft and what was proposed within exposure draft and why such things were proposed within those exposure drafts or discussion papers, right? So once you have an idea, examiner is not asking you what was an exposure draft. Examiner might be giving in any specific aspect of this exposure draft, and the examiner might ask you why this was proposed. So you need to answer it why this was proposed, only this thing. Okay, let's move to the rest of the portion of our question. This is the B part, whether amortization of intangible assets relating to television program rights by area company and by industries are acceptable policies in accordance with the IFRS standards. So what Laria company is looking into the television program content rights. So one thing Laria company has is actually amortizing its television content rights based on the revenue, expected revenue those were earned with respect to those television programs. One important thing you need to understand is the company always plan a budgeted cost for any program based on the estimated future revenues, and the cost is in line with the future revenues. Irrespective, IS 38, if you have looked into the IFRIC's International Financial Reporting Standard Interpretation Committee's documents, or SICs for International Accounting Standards, you might be looking into SICs, and for all the IFRS you will find out IFRS ICs. So in this case, when you're looking into SIC, I don't recall exactly what specific SIC is related to this IS 38, this section, but IS 38 prohibits recording of amortization based on the revenues of an item. But in this case, IS 38 allows you, if you can link the revenue or revenue of an item with respect to the cost of an item of that intangible asset, then yes, you can recognize the amortization of an asset based on the revenue recognition criteria of any item. So it is allowed by IS 38, but it's conditional. What condition is? If revenues and costs are in line, only in that case amortization can be charged based on the revenue earned by the company, right? But this is allowable, and you can find out this specific guideline within SICs. In this case, examiner don't ask you, or the examiner has not specifically asked for such interpretation. It's no doubt mentioned within your answer, but if you want to answer it, you can easily answer it. This seems to be appropriate because the revenue earned by the company, by Laria company, is actually the cost that you are going to incur for that intangible assets is actually in line with the future revenues that the company is expected to generate from that specific asset. So in that sense, the policy of amortization applied, or the estimate of amortization which was calculated by Laria company, it should be equal. And one more thing, I have just mentioned the policy is not the policy. Amortization charge is neither an accounting policy. It should always be an accounting estimate. Apologies once again, it's not a policy. It's always a accounting estimate. So the estimate of amortization charged by Laria company with respect to this television program content makes sense. And as far as the industry practice is concerned, that also seems appropriate. If the industry is charging the amortization of intangible asset based on its useful life, that also makes sense for how long you can generate the revenues from that specific asset. That both of these two make sense. It's not something that we are going to make sure that something is wrong. As IS 38 and IS 16 mentioned, that depreciation or amortization is a charge which is applied as a reduction in the value of an asset, in the carrying value of an asset, based on the expected benefits drawn by the management. Along with it, the management expectation about the obsolescence of an item, of brokerage of that specific item, of a lower use, future use with respect to that item. So there are many other expectations associated with specific items. So it's depending upon the management of certain company which consider it by how they are going to charge them what is it. So both of these two estimates are correct as far as I understand. No any estimate was considered to be as a wrong estimate. So both of these two estimates could be considered as okay with respect to the international accounting standards guidelines. Yes, SIC 32 website cost. I think yes, that could be the case. Still, the screen is paused. No, screen is not paused. It's visible to everyone, I believe. I'm not sure. I believe my screen is visible because it's not. Yeah, it's not locked with me. It's not paused at my end. Might be there's a connectivity issue. Okay. Thank you, everyone. So the last thing is player contract cost. What is the requirement of player contract cost? How to account for the player contract cost, including the contingent performance conditions and any impairment which might be required to those non-current assets, and where a player can be considered as a single cash generating unit or not. So in this case, first thing is how we are going to account for with respect to the contract costs associated with the customer, also with the player. So if you're looking into the cost that you have incurred for the player registration, should always be considered as an intangible asset which was correctly treated by the LARIA company, right? So initial recognition was always based on the fair value of the consideration paid for the acquisition, Along with it, however, if you think that the player subsequently can renegotiate a contract and you need to change the value of its you need to change the price you are paying to the player for its services, but as this price is related to the future aspect, so you have to record this renegotiating cost once this renegotiation occurs. Before this, you cannot recognize it, right? But if it is highly probable that you have to renegotiate the cost once the probability of this criteria is high, and it will give you the more faithful representation of the item within the financial statement, then you have to provide that cost immediately as of now, because it's going to be your obligation in the near future under IAS 37 provisions and contingent assets and liabilities. You have to recognize this within your books of accounts. Is it clear to everyone? Second thing is, player's contract may contain a contingent performance conditions where individual player may be paid a bonus based on the success in terms of goals scored or the success of football team as a whole. I'm going to give you a reference with respect to IFRS 10. If a parent company is required to pay some contingent consideration to the subsidiary company shareholders who left the company, that contingent consideration should have to be recorded based on the probable estimate that should be paid in future. So even in this case, if there is a contingent consideration with respect to employee performance and you think that contingent consideration, the probability of that contingent consideration, how much is probable that you're going to pay the bonuses to the players, you have to recognize it immediately. And at some later subsequent events reporting, you have to change that contingent consideration with the charge in profit and loss account. If the contingent consideration as a result of later interpretation or later evaluation, you find out that the contingent consideration might have increased in the current year compared to the original estimate, then you have to charge an additional expense to the profit and loss account. But in case if your estimate of contingent consideration reduces the performance obligation for the players, then you have to reverse the expense related to the contingent contract with the employees in the previous year. That should be reversed in the current year, and this should be considered as a change in accounting estimate, not a policy, right? So change in accounting estimate and policy is a very important topic you need to understand. In this case, if you have made an estimate with respect to future with respect to the consideration you're going to pay to the football team players, that should be for as a change in accounting estimate and must have a prospective impact in your financial statements, right? So this bonuses, the additional contract cost should be accounted for based on the contingent consideration criteria and based on the most probable outcome of future bonus payments should be recorded immediately right now. Next thing is how you are going to record impairment. As individually you cannot evaluate the performance of a player, because individual player is never be a revenue generating individual for the company, except in a condition if the player was sold out to any other party, then this is the only case when you can recognize the revenue from that player. But most of the time when you are going to charge the impairment to a cash generating unit or any asset, it only be calculated based on two criteria, based on its recoverable amount. So how you are going to record the recoverable amount of any asset? The recoverable amount of any asset is always higher of value in use of that asset or NRV of that asset. In case if you are considering what is the value in use of that player, that value in use should only be calculated if the player is playing within the team, because individual player playing in a ground doesn't mean anything to the club. So it can never be treated as a individual. You cannot charge individual impairment to the player. You can only charge impairment to of that player if he is working as a cash generating unit within the team, right? Any question as of now? If the probability of contingent consideration is 0, then it's not even a probable situation. It is a remote criteria, and if it is a remote criteria, then it's neither an asset nor a liability. Second condition, you're looking into the possible situation. Possible situation means happening or non-happening of something in the future has a chances of more than 6% to 50%. If you have a 50% chances, it is always a possible situation. Probability means which outcome has the most probability of happening of something, that should always be recorded. I don't get the point. VIU and fair value less CTS, whichever is higher and not NRV. Sorry, I don't get the point. Yes, player is not a separate cash. Player is not a separate cash generating unit. It could be a separate asset, but impairment cannot be charged on the player as a separate asset. Impairment should be charged based on as a team, as a cash generating unit. The whole team should be evaluated for impairment test. You need to look into the basic requirements. I'll be guiding it a little bit later. Yes, non-current asset is basically related to this specific situation, the player contract cost. Value in use in NRV. Yes, first you need to, okay, give me a second. I'm going to show you how IS 36 actually works. So this is IS 36. Whenever you're going to charge impairment on any asset, so impairment recognition criteria must be based on when there is an indicator of impairment. You have to run an impairment test. And what is impairment test? If as a result of impairment test recoverable amount is lower compared to the carrying value, then recognize an impairment. If the carrying value of an asset is higher and recoverable amount is lower, then you have to recognize an impairment, right? So we need to find out what is recoverable amount. Now our comparison is recoverable amount with the carrying value. So if you are confused about it, so I'm saying something else. So that concern was for another aspect. I'm going to discuss it with you. Now I'm going to test for impairment. I have to compare the carrying value of an asset and recoverable amount. And if recoverable amount is lower compared to the carrying value, which is higher, then there must be an impairment recognized. But we need to find out what is the recoverable amount of an asset. Recoverable amount is always higher of what? You need to compare the net realizable value of an asset, that is selling price less cost to sell, and value in use of an asset, that is the future projections, how this asset will give you the inflow of economic benefit. If you are looking into the player aspect, what are the cash inflows generated from that player when you are using that player within a game? And then if the player performs well, you'll be getting some inflow of cash inflows for your business, for your club, right? So the cash flow projections, value in use of that specific player can only be calculated if you are calculating it based on the teamwork, as a teamwork, not as a single individual player. Individual player is of no use. They cannot be used for generating revenues. Yes, you can sell out that the contract of player to any other club. That's the only case. NRV, we have to find out what is the higher of these two. So whatever is higher, you have to record it as recoverable amount in this case, right? So I would be considering that this individual should be, or the impairment of a contract player should always be considered in conjunction with the cash generating unit criteria rather on an individual basis. I think the document name ED 2019-6 that was uploaded is actually expiry draft 2019-7. No, I don't think so. Give me a second. Might be. It could be a mistake. Let me check. Expiry draft 2019/6. You're asking about this one document? Oh yes, it's expiry draft. No. I think due to this change, COVID-19, no, this is expiry of 2019-6. Okay, if this is not expiry of 2019-6, I'll be looking into it in more details and I'll be getting back to you on the WhatsApp group, or I'll be sharing that document with the organizer and he is going to upload those within the section of what should say, the handout section, from where you can download from ACCA website. So I'll be requesting the organizer, he'll be uploading exposure draft 2019 by tomorrow, max by tomorrow. Okay, thank you so very much for looking into this. And if there is any other concern, you can approach me on my number I have shared with you guys. So I'll be updating if there comes something that was mistakenly uploaded within these documents. Patents, trademarks can be separate cash generating unit. You can, and you can not be. Trademarks are always considered to be for impairment test on the basis of cash generating unit, but if there are patents, you can lend the patents to some individual on the royalty basis. So you might be earning royalties on those patents. So it could be possible that you are lending out those patents to some other individuals from which you can generate inflow of economic benefit. So only individually with the help of those patents you can generate inflows. So that's a different situation. So it depending upon the situation. Yes. I'll be sharing those within the group. I have read fair value less cost, not NRV, while comparing with VIU to get. I have read fair value less cost to sell and not NRV. Yes, fair value less cost to sell is actually NRV, net realizable value. So what is net realizable value? Net realizable value means the net amount you're going to realize with the sale of an asset. NRV and fair value less cost to sell is the same thing, or selling price minus cost to sell is the same thing. You need to identify there is a difference between fair value and NRV. So these are the two different ideas, right? But if you are asking fair value less cost to sell or NRV, it's actually the same thing. So if exposure draft 2019-6 is disclosure accounting policies proposed amendments to IAS 1, so this document actually constitute IAS 1 amendment. So I believe this is a very detailed document. So you need to only look into IAS 1 amendments to IAS 1, and you're not supposed to look into rest of the things. It could be possible there is a new exposure draft which is an extension to the previous draft. I'll be looking into the details. If that is the case, then you're not supposed to read out the rest of the section. Those includes, I have told you earlier, those includes IAS 7 and other standards. So you might not be required to look into the rest of the standards. Where it is, yes, you only need to structure of the exposure draft. The exposure draft includes these two things. So you need to look into these two main things. You're not supposed to look into these rest of these standards. Only this idea should be evaluated, but I'll look into the details of this exposure draft and then I'll be updating you. Okay, any other question? Exactly, fair value. No, fair value is always the exit price. Fair value should always be based on the exit price. Now, fair value is something that you have to conclude. Fair value is always the price. Now, giving you an idea what fair value and what NRV means. NRV means you have to deduct all the cost related to question number 4. Do we have? No, I have actually included question number 4, which was related to the performance evaluation of the company, in which I have specifically mentioned free cash flows topic. But as we don't get the time, so we can be discussing such things. If you find out anything, we'll be discussing on WhatsApp group. But with the commitment that if I got time, then I'll be answering your question, and I'll try my level best to answer as much question as I can over the WhatsApp group, right? And one more thing, what is fair value? Just answering your question. Fair value and the difference between NRV means you are deducting all the associated costs related to an asset if you want to sell it. I'm going to sell an asset. I have to incur transportation cost. I have to incur some transaction cost. I have to incur any other cost that is related to an asset within the market where I'm going to sell it, like the cost which was given to the broker. Broker is a person who is within the market, who is actually helping you out to sell your asset, or it's the cost that was charged by the market on selling an asset within that market, right? Now, NRV constitute everything. What fair value constitute? Fair value only considered 3 attributes with respect to an asset. Fair value asks you to consider the location of an asset. Second, the condition of an asset, and third one, restriction on use of an asset. Fair value tell you whenever you are going to calculate the fair value of an asset, you are not supposed to exclude from the market value of an asset, you are not supposed to exclude the market attributes from the market value of an asset, right? If there is a brokerage cost, a brokerage commission, which is a market attribute, if you want to pay it, it should be deducted from the NRV calculation, but it should not be deducted from fair value calculation. Are you getting the point? So that's a different thing. Yes, commission cost or legal fee, most probably. I have one of the example from the local area, but most probably it's not understandable. It's not understandable for most of you, so that's why I'm not sharing that example to all of you. So just giving you an idea, a commission cost that is attributed to a specific market, that commission is for a specific market, or a legal cost that is associated with that specific market, right? But that cost or that expense is related to the market, and it changes from market to market. Only that amount should be excluded when you are finding out the fair value, while in NRV case you have to exclude all the related costs that you need to incur in order to sell an asset in the market, right? So that's the difference between market value and fair value. Oh, sorry, NRV and fair value. Is it clear to everyone? Okay, I hope we are done with all of things. I'm just getting back to you with IFRS 9 financial instrument. If there is any further question, do let me know. Otherwise, I'm moving to IFRS 9 financial instruments to give you a idea. It's a very lengthy standard. You can see it's a very detailed standard. I'm not sure if you're looking into it. This is so much detailed standard that it might not be possible to discuss the whole standard in much detail. I'm just giving you a idea how you can account for, how you can look into this standard. Okay, someone else has a question with respect to NRV and fair value. I hope it's clear to that individual that fair value is an entry and NRV is an exit price. So that's not the case. And fair value is always based on as an exit price. I believe I have shared with you guys IFRS 13 fair value measurement or not. Give me a time, I can check it once again. Might be I'm wrong. I'm not asking that I'm always right. I'm also a human being, and mistake can be expected from any human. So let's see. So fair value. But I believe it's always an exit price. Fair value is not an entry price. It's always an exit price. This is the exit price. Okay. Entry price is something the price paid to acquire an asset or receive to assume a liability in exchange of this. So that's an entry price, and the other one is an exit price. I have already shared the notes with you guys, all of you, within the handout section. I have already shared in the PDF format. I'll check it once again. If you think that fair value is, yes, I believe fair value is an exit price. I am saying the same thing, but I'll be checking it once again, and I'll be coming back to you on this over WhatsApp group. So that's not the case. But as far as my understanding is concerned, under IFRS 13, fair value is always an exit price. And NRV, you can't say that NRV is exactly exit price. Okay, coming back to IFRS 9 very quickly. Any further question? Give me a second. Excel file is a very huge file, and I might not be able to attach it. It's a very huge file, and most of the time this file got hanged with me. So it is not possible. I'm going, but there are a lot many examples in this file, and it's a very heavy file. It's a linked file, and if you can see, I'm going to close it and open it. It always shows an error, so it might not open properly within your system, or it might got hanged. So that's why I have not shared it. Right, so it's a very heavy file, so that's why I have not shared it, and I have added a PDF file with you guys, because once I'm going to share this Excel file with all of you, and everyone is going to ask me that this file is not going to open. I have sent it to few of my fellow members, and they are not able to open it on their system. I'll try to upload it on a drive, and then if it got uploaded, then I'll be sharing the link with you guys. Okay, moving to IFR, financial instrument. So financial instrument is a topic to which three basic standards are related. One is IAS 32, which is actually concerned with how financial instruments should be presented. IFRS 9, which give you a guidance on how the disclosure requirements of financial instruments should be accounted for. And IFRS 9 is actually the standard that give you an idea how financial instruments should be measured. So one more thing, we have to identify how financial and non-financial items should be bifurcated. You need to make sure that financial instrument, any asset or a liability that should be named as a financial item, should meet these two criteria. First one, it must have a contractual obligation or a right. You must have either a contractual obligation. If it's a contractual obligation, then it is a liability. If you have a contractual right, then it is a financial asset. Secondly, it must be settled in cash or any other financial instrument. So the settlement must occur within cash or any other financial instrument. Cash is itself a financial instrument. How you can say cash is itself a financial instrument? You have a contract with the central bank. We have already discussed in the section. Cash, you have already a contract with the state bank, with the central bank of a jurisdiction, that he will guarantee you this paper, the currency note, the paper worth that amount. If the currency note loses its worth, then central bank of this jurisdiction is going to reimburse you that amount. That's why once the currency notes were changed in India recently, those notes were exchanged by the central bank, or all the banks are changing those currency notes on behalf of the central bank. Are you getting the point? Because that was a commitment by the state bank or the central bank, right? So that's the idea of the cash. It is a financial instrument. So we have few of the examples how you can differentiate between a financial item and a non-financial item. For example, if I say, if you have few of the expenses payable, so do you have a contract? Yes, we already entered into a contract against which we have received the services or we have received the goods. Now, against that contract, I have an obligation to deliver the cash, right? So any expenses payable should be treated as a financial item or a financial liability. If you have some prepaid expenses, you have paid the cash, you enter into a contract and you have already paid the cash, right? Now you can say we have already contract in place, but do this transaction be settled in cash? No, this transaction must be settled in services. You have already paid the cash. Now either you will be receiving services or you will be receiving the goods, not the cash, not any other financial instrument. So any prepaid expenses you have paid should not be considered as a financial item. These are always non-financial items. Inventories, we neither have a contract to sell this inventory to any other individual. So as you don't have a contract, so it must be treated as a non-financial item. Irrespective, you can say or you can argue with it that inventory should always be sold in cash. I agree, inventory should always be sold out in cash, but you don't have an existing contract for the inventory that I'm going to sell this inventory to you within this amount. So it is a non-financial item. Equity instruments are always considered as, are by default considered as financial item. Why? Do you have ever read out in any of the book that on the liquidation of a company, the directors of the company called up the shareholders and asked them to take few of the asset along with them as the winding of the company? It's never gonna happen. On the winding of the company, all the assets of the company were sold out in the market and the cash was accumulated by the sale of those assets or realized by the sale of those assets. And out of that cash, first the obligations were paid out, and if there is something remained, if there is some amount remained within the company with the liquidator, then liquidator is going to distribute the remaining sum to the shareholders in their proportionate shareholdings, right? So equity instrument, if you have a confusion why we are considering equity instrument as a financial instrument, because you have already entered into a contract with a company that you are investing this sum of amount with the company, and on the liquidation of that company you will be receiving cash back as a result of that contract. So both of these two conditions are met with respect to this equity instruments. Last thing is taxes payable. Last thing is taxes payable. So taxes payable is always considered as a non-financial item. Why? Because taxes payable is never a contractual obligation. It is a legal obligation. If government is asking me that Amjad, we are going to enter into a contract with you and you will be paying this amount of taxes in the next year, I will never enter into a contract with the government. So government is not asking me or requesting me to enter into a contract for taxes payment. Government is imposing on me via a legal you can say with a legal document, with the law passed within the parliament, that I am supposed to pay those taxes to the government. Irrespective, the taxes payment always results, all the taxes payment was always settled by the cash payment, not by any other asset delivery, but always by a cash payment, right? So yes, its settlement always occur within the cash, but as the first condition was not met, it is not a contractual obligation, it is a legal obligation. That's why we treat these taxes payable as non-financial item. I hope this is pretty much clear to everyone how financial and non-financial item were bifurcated. So if you're looking into financial instrument, they are basically financial obligations or financial rights, contractual obligation, contractual rights. If it is a contractual obligation, that always results into a financial liability, and debt instruments issued by a company are always the financial liabilities. Any debt instrument those were acquired are the financial asset, and equity instrument are always considered as a financial asset, because you are going to purchase an equity instrument of another company, so you can consider that as financial asset. I'm going to look into the main terms, and then I'll be going directly onto the impairment, which is the most relevant portion of this IFRS 9. I'm not moving to the derivative because that was a very complex topic and that need a lot of time to get that specific portion discussed. I'm looking into the impairment. I'm giving you an idea how you can easily understand the impairment that was provided within IFRS 9, and most of the students find it very difficult to understand. So let's go through the main terms. Nominal interest rate is the facial interest rate of a document, and company is always going to pay the interest based on this nominal interest rate. Interest is never paid on the effective interest rate criteria. It's always paid on nominal interest rate. What is nominal value? Nominal value is the face value of a debt instrument. Interest payment is always interest payment calculation is always based on nominal value multiplied by nominal interest rate. So interest payment to the issuer of to the purchaser of the loan note should always be based on these two criteria. So the payment are always based on nominal value, nominal interest rate, nominal value into nominal interest rate. What is the opening or issuing value of an instrument? Few of the debt instruments are issued at discount and few of the instruments are issued at par. So the issue value is what amount you have received by issuing a document, what amount you have received, actually received. For example, if there is a loan note of 100,000 and you have received 100,000 against a document, then it's something you can say it is issue value of that document. But you have issued a document at discount, that I would simply say that you have issued a document of issued a 100,000 nominal value document at $95,000 cash, then the issuance value or opening value of that instrument is 95,000 rather 100,000, right? Effective interest rate is what? Effective interest rate is the internal rate of return of that document. That is the real interest rate on the basis of which you are paying against that loan, right? So that on the basis of this, you are paying you are charging an interest expense to the profit and loss account. So interest expense should always be calculated on this percentage. And how this effective interest rate should be calculated? This should be calculated based on IRR. I hope everyone has an idea what IRR is. It's internal rate of return. You have read this specific topic within F5 and I believe F9 in more detail. So at SBR level, examiner is not going to ask you to calculate effective interest rate. It's always given in the exam because this is not the part of our course. Our course basically rotates around the application of accounting standard. So anything that could be used in accounting standard, which will always be provided by the examiner, right? So someone is asking me, I think in yesterday or day before yesterday, someone is asking me about the hedging technique. So I told him that Examiner is not going to ask you to calculate what amount of hedge should be included in it. All the hedging data was always provided by the examiner. You need to only account it for how the accounting actually works, right? So you should not be very concerned about how specifically hedging works. You need to make sure how hedge accounting actually works. So what is the redemption value? The value on which the loan should be repaid. It could be redemption at par, that is the 100,000 loan note should be redeemed at 100,000, or it could be redeemed at premium, like you might have to pay 1,20,000 on the redemption value along with this nominal interest rate that you are paying on annual basis, right? So any additional amount you're paying on redemption would impact this effective interest rate to increase. What is contract term? Contract term means the time period for which this contract of financial instruments runs. It could be 5 years, it could be 2 years, it could be 10 years, it could be as much years as mentioned within the contract. Transaction cost is a cost that was incurred by any party to enter into the financial instrument contract, right? So that's basically the criteria of financial instrument. So these are the terms, and I hope everyone is clear about how fair value through profit and loss, amortized cost, and fair value through the comprehensive items actually works. We are left with just 2 minutes. If it took further time, I'll be looking into rest of the things. Right now I'm looking into the impairment, the main topic where I believe you guys have a confusion. So how to charge impairment and how this impairment actually works is, impairment of financial instruments. One important thing is impairment is only applicable to assets, financial assets. Financial liabilities are never going to impair, right? So impairment should always be That's a very interesting question. I would always say to all of my students, be very optimistic. Be very optimistic. Why you are not able to answer a current issue question? You have an idea about it, so you must answer whatever comes into your mind. Never consider to not to attempt a single question in your exam. Try to make your level best that you are answering each and every question within your exam, to make sure to give an idea to the examiner that yes, you understand. And answer to your question is always available within the scenario. Within the scenario, it's always available, right? So you only need to make sure you have a better understanding of the standard, and you're applying that standard to that specific situation, right? So be very optimistic. Be very optimistic and be very confident in yourself that yes, I can. And frankly speaking, when you have this sort of intention in your mind, you can easily pass the paper. Your paper is not gonna fail, never. But with an intention that yes, I can do it, and you can. And I believe in all of the students that they can. Once this negative thought comes into your mind, then your mind stops working. And in most of the cases, you are not able to answer those questions to which you think I can answer. So be very optimistic and always consider that I can do it, right? And as far as if you are asking me and I'm your examiner, if you are not going to attempt a single question, if I will be the examiner, I'm not going to pass you. That's my understanding. That's my understanding. And it's not demotivating for anyone. It's a motivating thing that you always consider yourself to answer each and every question available in your exam, irrespective of what it costs. Because you have to answer it from the scenario, right? So if you are reading out the scenario and putting a bit of effort into the question, you can answer it easily. Easily you can answer it. SBR is not a difficult paper, frankly. Okay, we're looking into impairment of financial asset. How impairment of financial asset works? IFRS 9 impairment rules are only applicable to financial assets which are held at amortized cost or fair value to other comprehensive income. FVTPL instruments, fair value through profit and loss instruments, are never subject to impairment. And one more thing, IAS 36 does not apply to IFRS 9. Why? IFRS 9 itself provides rules and guidance how the impairment should be charged. So we are not going to apply IAS 36 in this situation. We're going to apply IFRS 9 requirements, how to charge impairment. But as far as fair value through profit and loss, fair value through profit and loss financial assets are concerned, you are never going to charge impairment rules on such assets. Now, why you are not going to charge impairment rules on fair value through profit and loss instruments? Because if you are going to look into the consistency of the accounting standard, I'm going to just give you an idea. Just recall IAS 40 investment properties. If investment property was carried at cost model, then IAS 36 rules applies to that investment property. But if an investment property was carried out at fair value through profit and loss, right, at fair value model, and any gain losses, those are arising on the valuation of investment property, those should be charged directly to the profit and loss account. IAS 36 does not apply on investment properties. IAS 40 investment properties, those are carried at fair value model. In the same way, any financial instrument that is carried at fair value through profit and loss, impairment rule does not apply to those instruments. It's a consistency between the accounting standard, right? So which is the basic requirement for your framework as well. So you need to align those things within your standards. I hope that makes sense to everyone, that how we're going to account it for. Now, how impairment actually works, or how the impairment rule should be applied for IFRS 9. It's basically, you need to find out the credit losses. Credit losses are calculated based on the credit risk of an instrument. What is the credit risk? If the credit risk, if there is no significant increase in credit risk, then it means there should not be a greater impact or greater devaluation in the value of an asset. But if there is significant increase in credit risk, you must consider that yes, now the value of the financial instrument is declined in a more value compared to what you've already mentioned. Credit impaired asset is one asset where either the issuer of the document might have default, or he might have explicitly told you that he is not in a position to pay you any further amounts except this amount. Those are the credit impaired asset, right? Or any issuer who is in the process of liquidation, and as far as liquidation concerned, you came to know that this as a result of the liquidation process, you might be able to get this specific amount. You can say yes, this instrument is gonna be impaired right now, right? So how to understand? I hope every one of you have read out the allowances creation on receivables. You have to create a general allowance, a specific allowance, and a bad debts write-off. There were three conditions. General allowance means you have an expectation that out of all the receivables, you might not be able to receive like 2% of the receivables, irrespective of what customer it is. It could be any customer out of the thousands of customers you have. But 2% of the receivables you're not able to collect every year. That is an estimate. So no significant increase in credit risk is just like a general allowance. What is specific allowance? When you come to know that this specific customer A is in financial difficulties, he or she has not refused yet for paying against the receivables, for paying against what he is supposed to pay you, but he is in financial difficulties, and now you are estimating how much amount can I recover. So based on this, you have to create a specific allowance for that specific individual customer, and that allowance is most of the time equals to what you are expecting that you're not receiving from that specific customer, right? Last one is bad debt. Once a credit customer is gonna bankrupt, only then you are going to write it off, or the customer was disappeared, or the customer explicitly refused you, I am not able to pay you, then you have to write it off, right? So these criteria should be applied in the same way for your understanding what is the meaning of significant increase in credit risk, or sorry, no significant increase in credit risk, significant increase in credit risk, and credit impaired assets. So that's the main idea of it. So what about the maximum losses you can recognize under these three credit losses categories or credit risk criteria? If there is no significant increase, by the way, the maximum losses constitute two things: 12-month expected losses and lifetime expected losses. So how to account for these 12-month expected losses and lifetime expected losses? You can account it for in here. right? No significant increase in credit risk means you have to record a 12 months expected credit losses from the carrying value of financial instrument, right? And if there is a significant increase in credit risk, you have to calculate the lifetime expected losses on the financial instrument. Third thing is, in this, after applying these two, the interest calculated on both of these two assets, whether there is no significant increase in credit risk on a financial instrument or there is a significant increase in credit risk of financial instrument, you have to calculate interest based on the gross amount of that instrument, right? In the same way, if you are creating individual allowance or a collective allowance, either you are creating a general allowance or specific allowance, you're not going to reduce the value of an instrument. You are going to create an allowance, like you are going to make a double entry, debit bad debts write-off expense to the profit and loss account and credit increase in the allowance, right? Is it clear? But once you have a bad debt expense that you need to write it off, what double entry you are following? You are following bad debt expense, debit and profit and loss account, and credit your receivables. You are actually reducing the value of receivable. You're not creating allowance. In the same way, if you have either significant increase in credit risk or no significant increase in credit risk, you have to create an allowance. And as allowance was created, the value of asset was not reduced. You have to calculate the interest based on the gross amount of those instruments, right? This is the criteria. I'm not looking into this criteria. I'm moving into the credit impaired asset. If it is a credit impaired asset, you have to calculate the lifetime expected losses on that specific instrument, and it should be treated like a bad debt write-off. You have to decrease the value of your financial asset with this impairment, right? And now, as the value of the financial instrument was declined, the interest should always be calculated based on the net value of the instrument rather on the gross value of that instrument, right? So that's how credit impairment of financial instruments actually works. Another thing, in most of your questions, because this is a discussion paper, I'm giving you an idea how hedge accounting works. I know the time is 10 minutes over, but give me just 4 or 5 minutes. I'm giving you an idea how you can account for derivative, if it should be derivative, if whether you are going to account for that derivative under hedge accounting, or if you can apply the hedge accounting or not. So for the application of hedge accounting, you must have to meet 3 conditions. You must have to meet these 3 conditions in order to apply the hedge accounting. If any of this condition is not applied, then you cannot apply the hedge accounting. First criteria is there must be an opposite correlation between hedge item and hedge instrument. It means the value of hedge item, if the value of hedge item is increasing, then the value of hedge instrument is actually decreasing. So there must be an opposite correlation. Second one is hedge item and hedge instrument must be equal in number. Hedge item and hedge instrument must be equal in number. The last thing is there must have been an existing hedging policy. You must have a hedging policy in existence for the application of an hedge instrument, right? If you don't have a hedge policy, that is a documented policy, the company must have already a document in place. The treasury department or the risk management department must have already created a policy document that if such risk comes up, then we are going to hedge this risk using such techniques. So there must be a documented policy available. If any of this condition is not met, you cannot apply hedge accounting. You have to apply the speculation accounting, that is, you have to carry this debt instrument at fair value through profit and loss. Simply, in any gain loss on that derivative instrument should be charged to profit and loss account, and on the disposal any gain loss on derivative instrument should be charged directly to profit and loss account. So that's the accounting. So hedge accounting can only be applied if these 3 conditions are met. I hope if you remind these 3 conditions, you can answer like 30% of your requirement. 30 to 50% of your requirement would be answered if you know these three basic requirements, right? Any confusion as of now? Okay, guys, thank you so very much for your time. And I think most of the topics that I considered are some importance to your exam. You can go through those topics, and apologies to the last question. This is actually a recorded lecture, so you can go through those lectures from the portal. It's a very awesome session, and I really enjoyed this session. Frankly speaking, the participation from you guys, it's really appreciable. One of the question right now from one of the participant I got is, what are the writing tips? So most important tip is you have at least a good grip over your English, because we are always supposed to answer all the questions in within the exam. Another thing is, your 80% of your answer lies within the scenario. 80% of your answer, you only need to extract that from the scenario. That's the main idea. That's how you can answer your question. So as far as if you are with me within the last 3 sessions, within the last 4 or 5 days, or last 4 days at least, you always have to been looking into it. I am always extracting my answer from the question rather developing something from my own. I'm always developing the answer from the scenario. I will always snatching the answer from the scenario, because you are supposed to answer the situation, and if you are not considering your situation, you are not able to answer it, right? So that's the only tip how you can answer your question. If there is anything else, do let me know. And thank you so very much, everyone. It's really an interactive session, and frankly, I enjoyed it a lot. Thank you so very much, all. We'll meet at some point later, if in some sort of lifespan. So thank you so very much. And rest of the documents should be shared. I will try. I will try to upload this Excel file over the Google Drive. If it get loaded, then for sure I'll be sharing the link with you guys over WhatsApp group. Thank you so very much, everyone. Thanks a lot. Bye.